Today, I'm here to tell you about one of my favorite investment tools, and that's a home equity line of credit. If you don't know what a home equity line of credit is, or what's often referred to as a HELOC, it basically is a revolving line of credit that's attached to a primary or second home. It must be a non-rental property for the scenarios that I'm giving. So let me give you an example of why I love this product and two misconceptions that are often misunderstood about home equity lines of credit. So to give an example of a common case of a misconception is, let's say that your home is worth $1 million and that you want to borrow the equity within your home. So let's say there's a debt or a loan balance of $500,000, and if the home's worth $1 million, there's $500,000 worth of equity. Well, the lender looks at it a little bit differently. They look at the value as 80% of the total value. So they would look at the value of the home essentially as $800,000. And so the gap between $500,000 owed on your loan between $800,000 is $300,000 worth of usable equity. That's a lot of equity. Most borrowers are very common for borrowers to think, well, I have so much equity, I can just qualify for a home equity line of credit. And that's not the case. There's other criteria you have to meet besides having a significant amount of equity, like your credit score, your debt to income ratio, your assets, your occupancy type. These are all important factors to getting a home equity line of credit approved. And it's a big misconception that just because you have the equity means that you can get the funds out of your home, which is not the case. The other misconception as far as qualifying that's a little bit more complex, but I think it's worth mentioning, is let's use a different example where you want to just withdraw $100,000 out of your home equity line of credit. Assume you already have one. So if you have $100,000 that you want to withdraw and your rate is probably in the range of 6.7 to 7.25 for these types of terms, that payment that you're going to have on your home equity line of credit is not a principal and interest payment. It's just an interest-only payment. So an interest-only payment means you're only paying interest and none of the balance of the loan is going down, which can have its benefits because, of course, your payment's going to be lower. So if you had a rate of 7.25 and you're going to borrow $100,000 and it's an interest-only payment, it's about a $605 payment. And so that's not how the underwriter qualifies you, though. As the borrower, you're like, great, this is a really low payment to borrow $100,000. But when it comes to actually how the underwriter reviews the file, they actually look at the loan balance, when in this case is $100,000, and they take 1.5% of that. That means they use a payment of $1,500. So instead of having a qualifying payment of $605, they use almost double or more than double what the payment's going to actually be. And so it's harder to qualify for home equity lines of credit. Now, not all lenders use 1.5% of the loan amount, but usually there's some variation and it's always a higher payment. So it's a reason why it can be harder to qualify for home equity lines of credit. Another really big misconception about home equity lines of credit is that when you close on them, that means you have to withdraw the funds. So in our example of $1 million home, your loan balance is $500,000. There's $300,000 worth of equity to use in this scenario because you're using 80% of the value, which is $800,000. You don't have to take that money of $300,000 right away. You can use those funds really as you choose once you close on the home equity line of credit. So let me go a little bit further on what I mean. So in a home equity line of credit, there is a draw period. A draw period means that you can withdraw those funds out of your home, or that equity out of your home, and deposit into your checking account for either 10 or 15 years, depending on your lender. Those are the common terms. I personally like the 15-year draw period because I'm a little bit younger, and I think this probably means I'm going to invest for a longer period of time. So basically, for example, me personally, I closed on a home equity line of credit a few years back. I never withdrew the funds, and I paid zero closing costs. I paid what I would call miscellaneous mailing fees, which was probably under $100. And I was able to get a home equity line of credit. Now I have access to these funds for the past few years, but I just have never used them. So I don't have a payment. I don't have an interest payment. And so therefore, for the remaining, now 13 or so years, I can use those funds when I choose. And they provided me a check booklet of being able to write a check to myself and put it in my bank account. And if I ever want to make my next real estate move or need a repair on my home or need access to funds quickly, it's a great way for me to get funds really quickly from my home equity line of credit. So that's a really big positive. Another positive in investment in second home markets, because the Outer Banks, the common borrower that I talk to is typically buying a second home or investment property. A home equity line of credit really can come into play. It's very common for borrowers to use an equity line as part of their down payment. And so I want to talk about that just a little bit further, because it's common that borrowers come to me and they have found what they believe is the perfect home. And typically they are going to rent the home for a short period of time or seasonally, and they're looking at it from a cash flow perspective. And they already believe, they're like, yeah, I want to get a home equity line of credit, but I don't have one in place, and I've just found a home that I really like. It's finally in the right location, has a good income and other things, and this is a home I want to buy. And in this case, they have to close on 2 transactions during the purchase contract, which makes it extremely difficult. And I've done this before, where a client would want to crunch in a loan process for a home equity line of credit and close on the purchase of their second home and investment property, all within 45 days or less. And when you go through that process, I can tell you, borrowers feel stressed because there's 2 loan applications going on, different qualifying criteria is needing to be met, different conditions are being requested, and it's just a little bit of a nightmare for the borrower. A lot more proactive and better approach is to get the home equity line of credit in advance. It doesn't cost you anything, and because there's no closing costs. And that way, when you do find the right property, you're ready to deploy funds. Even if it's a year or 2 later, you have a draw period of 10 or 15 years. It really doesn't matter. So getting the home equity line of credit in place can be really critical and just make the loan process so much smoother when you go to buy your second home and investment property. I think there's one more scenario that I want to mention that can be applicable for home equity lines of credit. So stay with me here. Now, instead of being on a second home or investment property, let's just assume it's a young couple that essentially already owns a primary home, has owned it for a few years, but now they're having kids and they want to upgrade into a bigger home. So they're moving from primary to primary, but they haven't sold their home yet. They still own it. And the real estate agent, especially in metropolitan areas, real estate agent's going to know that a contingent offer on selling their current house is less likely to be accepted by a seller because it's contingent on that home being sold. So it's the seller's much more likely to accept either like a cash offer or a non-contingent offer. And so at First Heritage Mortgage, we have a solution for that, where we essentially do a bridge loan on your current home that you own, so you can buy your upgraded home with your intention, of course, to sell this one eventually. But that bridge loan is really used for time-sensitive situations because they are assuming, with the bridge, that you need the funds out of the home essentially immediately, and we can close a bridge loan within less than 2 weeks, and then you're going to take those funds and buy the new primary home. But that's not free, and they charge a fee for it because you're getting those funds within less than 2 weeks. So typically a bridge loan has anywhere from a point to a point and a half on it. So if you borrowed $500,000 on a bridge loan to then purchase your new primary home, and your intention is to sell your old primary home, that bridge loan cost, that fee, is probably at least $5,000 for you to have that bridge loan to then buy your new upgraded primary home. And so a great way to avoid that cost, that $5,000 fee, for example, is to get a home equity line of credit, because there's no closing costs on a home equity line of credit. So if you do what I'm telling you to do in advance, not only can you not have to write a non-contingent offer, not only do you have to not go through the bridge loan process to get the money so quickly, not only do you not have to pay a fee that's going to be fairly expensive, I think $5,000 is pretty expensive, you can avoid all those troubles if you had just gotten the home equity line of credit in place. I also just think it gives you great flexibility. Maybe you don't want to sell that home right away that was your old primary. And if that's the case, if you want to turn a rental house, you could do that a lot easier, given that you could get the equity out of it to then purchase your new primary home. Or when it comes to using a home equity line of credit for down payment, what if you didn't have to sell an asset? Like if you had a very positive appreciating asset in a stock or another physical asset that you didn't want to sell, if you had the home equity line of credit in place, you can maneuver funds around to where you can best use your cash to close to come up with that amount of money with a combination of things versus just having to sell a hard asset to do so. So it's a great way to diversify as far as how you come up with your cash to close. It's a great way to save fees, and it's a great way to honestly have a low payment. The hardest part about a home equity line of credit is paying it back. And the common solution, really, when it comes down to it, because it's a 10 or 15 year draw period, is after you've owned one of your properties for a while, you just cash out your money and pay off that home equity line of credit and get it into a principal and interest payment that's a 30-year fix. Otherwise, you do have to chip away at the balance and slowly make that loan balance go down because it's an interest-only payment. But interest-only, especially when it comes to rental property, is a great way to have a cash flowing asset. So when you buy the second home or investment property and you use an equity line, you can also even write off the interest, which is a tax strategy that I can talk about more. But I want to keep this video fairly short, and I hope you enjoyed it. I really encourage you to get a home equity line of credit. I did so myself. It gives you a ton of flexibility, and we'll talk to you next week. Please like and subscribe this video.